maybe with Jonathan. And I would like to...
In its current form and with its current membership, it's an experience of fire, a real trial through which the European Union is proceeding, but that fire will forge, we think, much stronger bonds and a much more cohesive whole for the future of Europe and the Eurozone in particular. Part of the policies that will get us there are not so much in the domain of the national governments of Angela Merkel and François Hollande and their peers, but in the domain of the central bank, of the European Central Bank. And my view is that today, what is going on in European financial markets is driven first and foremost by the extremely accommodative policy settings which have been set out over the last 12 months by the new governor of the European Central Bank, Mr. Draghi. His policies are designed to achieve a number of objectives. Firstly, to calm the tensions within the banking system, to reduce the difficulty for borrowers in Spain or Greece or Italy to be able to finance their businesses at market rates. And by and large, that objective is in the course of being achieved currently. The second objective is to restore confidence to corporations for capital expenditure, to investors for capital raising, and perhaps that could be one of the triggers to help renew the IPO market in Europe for Israeli companies. We certainly think that will happen. So restoring confidence to corporations, restoring confidence to individuals, to households. And the sum of all of these measures will be a return to sustainable growth in the Eurozone. We're not there yet. So in the interim, and to answer your question, the most attractive markets we see in Europe are not the debt markets, are not corporate bonds or high-yield bonds, but rather everything that is linked to real assets and to equities. And that goes from convertible bonds through to listed equities, and into the more illiquid real assets such as real estate. We talked about German real estate earlier, which is an area that we also find particularly attractive, and through to more illiquid private equity type investments. So to summarize, we do think that for this year, next, and indeed many years beyond, there will be a return to favor for European equity markets, and we're recommending that our clients position themselves to reap full benefit from this move.
Just a question regarding the euro. Even if it will survive, the question is at what price? You see how over the years the euro has been weakened as compared to currency like the Swiss francs, the Singapore dollar. So if you invest in equities, why not investing in emerging market equities with stronger currencies than the euro?
First of all, when we invest in equity markets, we invest in companies and not in currencies. We're bottom-up stock pickers. And once we've found an attractive investment vehicle, we go long the equity, but most of the time we hedge our foreign exchange rate risk. So we don't want to run those two risks, but focus on the individual merits of the company. But to come back to your question about the attraction of the European equity market, much of it is linked to value, and the extremely attractive values that we see having emerged in European equities over the last 5 years. Everyone knows that prices have gone nowhere over the period. They're still well below the all-time highs and well below the highs reached in 2007. But at the same time, the profit potential, the growth potential of the European corporate sector has continued to improve. And so we look at cyclically adjusted earnings. So that's a 10-year moving average of the earnings made by companies or by companies aggregated at the market level, and compare that to current prices. And the reason we do that is that takes away the cyclical aspect. Equities will tend to look very expensive in recessions because earnings have fallen sharply, and conversely, at the top of the cycle, earnings may look cheap, but you're buying at peak earnings. Using our methodology, the market today is trading at historic lows. You have to go back to the early part of the 1980s to find as compelling valuations as those that you have today. Dividend yields are high, in many cases twice the level of government bond yields, and well over 30% higher than corporate bond yields. So there are a number of very fundamental, value-driven criteria that lead us to say that this is a compelling opportunity and one that we want to buy into.
Thank you. Alexander, we have a very special situation in Europe where we have almost no sovereign fund except perhaps Norway and Russia. Russia is an exporter of capital of over $100 billion per year. Your foundation, Skolkovo, has a fund of $3 billion. So what is the impact of the macroeconomic environment for fundraising? And it would be interesting also to know how can Israeli companies could attract Russian capital.
Thank you, Edward. I've got a tough job advertising Russia to investors and entrepreneurs, and I would probably, following a good tradition, start with a small joke from Russian recent history. Our Russian first president, Boris Yeltsin, was visiting the UK in '98. He was learning English, and his counterparty, Prime Minister John Major, knew that, and he used every opportunity to strike up a conversation with Boris Yeltsin in English. So he asked, "So how is it going in Russia? Tell me, Boris." And Boris said, "Good." And that was an awkward answer because Russia was in the middle of financial crisis of '98, and Boris came as part of the delegation asking for funding. So John Major asked again, "But honestly, tell me what's going on? How is life in Russia?" And Boris said, "Not good." And the bottom line is that Russia is a big and diverse country, and it is virtually impossible to describe in one word. And I will focus on relatively recent phenomena of Russia as a net exporter of capital. Its trade balance is positive, roughly $200 billion a year in the last 3 years, and a significant chunk of this surplus ends up in Europe, in banks in Citi, in Switzerland, in Cyprus. Some of that gets recycled back to Russia, but a significant part ends up elsewhere. We see significant activity in private banking, in cross-border M&A. Last week there was one of the largest deals in Russian history announced with Rosneft, a large Russian oil company, buying out British Petroleum for $28 billion, and there will be more stories like that. Looking at a relatively small market for private equity and venture capital, we see positive trends in Russian capital experts becoming more institutional. Until recently, it was mostly inwardly focused. Russian private equity is roughly 20 private equity funds focused on basic domestic sector, focusing on the growing middle class, which doubled in the last 5 years. And Russian venture capital is another 30 funds which focus on two things: software development for experts and internet for domestic use. So until recently, that was essentially internally focused. Now we see very positive trends of Russia investing outside. The government formed 3 development agencies, Skolkovo, Rusnana, and Russian Venture Company, and the last 2 recently backed altogether 8 funds domiciled outside of Russia and focused on investment as fund of funds and as direct investors outside of the country. Their total funding is close to $10 billion. Skolkovo as a development agency has got the government backing of around $3 billion, and it is focused on attracting relatively early stage high-tech companies to establish their R&D operations in Russia. And we are proud that there are a few Israeli-based companies which came to Skolkovo in the last couple of years.
Thank you. So our new guest, Alain, maybe you can as you have raised so much money for Israeli companies overseas, how would you advise an Israeli company or an Israeli manager to raise money in Europe, to get organized, to get?
Well, the short answer, echoing on Jonathan and Werner, is it's very tough today to raise capital. I think globally, not just in Europe. The large-scale deleveraging that we're seeing and all the uncertainty unfolding in Europe kind of over time now is just really creating a market that kind of has short windows that are open and then long periods of markets being closed. And I've been raising capital here for Israeli companies since the beginning of the year 2000, seeing kind of many ups and downs here over the years. And I think some of the key pieces of advice I would give to some of the issuers is, number one, is if you're looking to raise capital, is to prepare yourself, prepare the company, mandate counsel, hire underwriters, and have everything ready so when those windows do come, you're actually ready to push the button and issue. I've seen many issuers kind of hang back and kind of then they suddenly see that a bunch of IPOs are getting out the door, maybe it's a good time to go now, and then they start a process 3 or 4 months in, they get there and the market window's closed, and then they have another year where they can't raise capital. So I think that's one of the key things that I've seen over the years that makes sense to be ready so that when the windows come, you can push the button. I also think that a lot of issuers in Israel, I found kind of they seed certain opportunities in different global markets, whether it's in Europe, whether it's in Asia. Suddenly they see, I don't know, in Singapore, people are getting EBITDA multiples of 15, and in New York they're only 7, and suddenly Singapore is the right exchange, or suddenly Warsaw is liquid and people are running to Warsaw. I think I've seen a lot of issuers in the past kind of make the short-term mistake of kind of going quickly to a market where the short-term, result is good and they raise the capital, etc. But longer term, strategically, it's not the right exchange for them. They end up raising the capital, but over time they end up becoming orphan stocks, suffer on valuation, and later on have an issue with that listing and have to end up moving it somewhere else, and just a long-term mistake. So I think for Israeli companies, I think in many cases it's better to be patient and potentially to do private rounds of capital if you have an issue, go into the right strategic capital market for internationally, and to wait for the right time strategically to do that public listing.
Thank you. Jonathan, do you think the attitude of the investment community in Europe will evolve in the coming months, in the coming years, considering the current situation?
Well, look, I mean, I think I'd go back to what I said previously, which was there is appetite out there now. Do I think that's going to improve over the coming months? I think yes. I think anecdotally, as I said before, a lot of the discussions we're having, not just with CEOs but also with equity providers, would suggest that. That's yet to transpire, but I think that what's critical is to be ready. If we assume that sort of, as I said, the end of the first quarter next year, calendar quarter next year, is a time when things will be more accessible by way of financing, then given the lead time that we both agreed it takes to get businesses ready, one needs to start now, really making sure that everything is prepared so that exactly, as my colleague has said here, sort of the window of opportunities is accessed. I do think 2012, should be better. Specifically to Israel, there is a concern that investors have around Europe, particularly in London, about Iran, and that's been mentioned